Yep,
Now,
legend.
when it comes to ICT concepts, it's not just one model in itself. It's a variable of many models that are
Hmm.
implemented using the idea of identifying liquidity and using PD arrays for your advantage to determine where the draw is and what the
Yep.
probability of success is for price to reach that area. Now, I've
Sure.
been when you are. I've been there where, oh man, I took like five losing trades in a row. Maybe this doesn't work. Let me find a different
Yep.
strategy to try and make money. And you're correct. That is the worst thing to do because you're not letting yourself adapt to one ideology. The reason that
Exactly.
I love ICT is because it explains all of the whys for me. A big part
Hmm.
of why I stopped doing retail trading with levels and patterns was because I wouldn't understand why did this work for some people but not for me. ICT kind of helps identify why certain things work and why other things don't work and what you miss, which is why
Mm.
I enjoy it the most. And I think it would be a good concept for you to adapt as well. Essentially,
Yep.
the 2022 mentorship from ICT is a long series of things, but I think it can be pretty much put into a nutshell. Uh, right before you, I'm going to practically teach you the 2022 model so that you can try and find
Beautiful.
it on your own and practice it. But I do want you to keep something in mind. When it comes to becoming profitable and consistent, it isn't necessarily how many times the win rate is successful. It's a lot of
Mm.
variations of between psychology, risk management, and obviously having the correct model at hand.
Hmm.
Now, there's times where you see picture perfect 2022 model in front of you and it's going to fail. And you need to accept that. Not everything is 100% win rate. Otherwise, I'd be a millionaire. I wouldn't even be here with you. I'd be in
Of
a
course.
yacht somewhere.
That's right. No losses would be amazing, but it's not happening
Exactly.
anytime soon.
It's not realistic to expect that something's gonna work 100% of the times. What is
Of
realistic
course.
to expect is that it will work enough times with good management to the point that you actually make consistent money.
Hmm.
So the way that the 2022 model essentially works is we wait for price to do what is called a sweep of liquidity. Now, in case you're not aware of what liquidity is specifically, it is the highs and lows that the market tends to make within its swing points. So as we can see
Yep.
right here, price tends to move in swing points like this swing up here, another swing,
Hmm.
and another swing, and another swing. The liquidity that is generated are the ones between the highs and the lows. The upside ones, commonly referred to buy side liquidity. The downside ones are commonly referred to as sell side liquidity.
Yep.
Ideally, price will always be in pursuit of these liquidities to wipe out people, also known as liquidate people, out of their positions. So, for example, a lot of people bought longs in this area, here and here, for price to continuously push up. Since they are
Yep.
in profit, the market will ideally now try to pursue sell side to wipe them out and liquidate them to get them out of their positions by force. That's essentially how the game works. It is always the pursuit of liquidity with manipulation and distribution, and our objective is to identify when price is manipulating to then join the market makers and play alongside them for their hand. Now, easily,
Yep.
the 2022 model drawn out looks like this. We make a high, we then make a shift, we then retrace to any sort of PD array, you do your entry, the stop loss would be the very high that you have right here. So it would be like that, and your target would be the very last sell side within the
Yep.
model. That's how
That
it
makes sense. That's
looks.
what I guess I've understood so far too. So you've got to see that liquidity sweep first, market structure shift, look for your PD array, nail your entry, stop above that last high or low, and then obviously target, set
Yeah,
your target
ICT
where you.
managed to squeeze out like fucking hours of videos to explain
It's
this in
such
a
a simple
nutshell.
model here. It makes
Yeah,
sense. Yeah.
but the idea is essentially this is how it looks drawn out. The
Mm,
difference is actually finding it in live price and also identifying
of
when
course.
it's the correct time to take it. Because you could see
Yep.
this is an entry model, okay? An entry model is simply something that you just see in the 1 minute time frame or the 5 minute time frame and you slap your entry based out of it. This does not
Yep.
determine complete direction. There are other things in price that determines direction, which is what we call the draw of liquidity. But to now show a quick example of how this entry model looks in live price, I'm going to quickly look for some right here. Surely we had some last week. Alright, let's imagine this is one. So right here, price took out that low.
Yep.
Eventually took out this high. This isn't a picture perfect one. I'm trying to find perfect one for you. Alright, this one works best. So, you don't necessarily have to see a raid. The only times I would recommend the raid, that you don't use the raid, is if there's a divergence. Otherwise, always wait for the rate of price. Because this is like a sneaky move where market makers are wiping out the people that were originally trying to enter the move before the move happens. So you ever have that instance where you're in your position and then you get stopped out and then price runs exactly where you're thinking it was going to go? That's known as a stop rate.
Many times.
So
that's a stop rate, okay, makes sense.
Ideally, you want to wait for the stop rate to transpire before taking action. Now, in some cases, if you're not aware what an SMT is, it's a divergence that happens between NASDAQ and S, or if you're doing different assets between the ones that are similar, like gold and silver. In this case, we can see that NASDAQ made higher highs, right? But S could have done this. When the indexes, this happens vice versa. So when the indexes make higher highs or lower lows, and one of them fails to make a new high or one of them fails to make a new low, we call this a divergence in price. So similarly, let's imagine that, S did not make the stop rate, but because it did make the divergence, you don't necessarily have to wait for the stop rate because manipulation already happened. So you could already short the retracement, assuming that since manipulation already happened, you don't have to necessarily wait for it. In this case, there was a stop rate on NAS, so we don't have to. And right after, we see the displacement where it made a shift. Now, shifts can be tricky. Ideally, I would recommend you only want to care about the shifts that happen with displacement. If it's a wick,
it's the displacement,
where price simply just wicks into this, let's say right here, price just wicked into it and shot right up. I would not trust that as a confluence for price to tell me that it is ready to go to the opposite direction. I would want to see something called displacement, which is ideally when heavy-bodied candles moves towards a certain high or low with firm pressure, you could call it pressure, but with firm strength, giving you that hindsight that, okay, it looks like it definitely wants to go towards the opposite direction. So in this case, you can see how this candle is real nice and firm, close solidly towards the downside underneath. You could say that, okay, that's a shift. But let's compare to I want to go 2 away from the current setup that we have right there. Alright, let's compare this one right here. So this looks like price is trying to break out of it, right? You could say, oh, this could be a market structure shift, but do you see any displacement here?
No, not strong enough there.
Exactly. So that's a hint that price might actually not do that. Now, it could definitely bounce from this fair value gap that it has right here, but in this scenario, it ended up taking out the lows, which if I had taken a trade here, would have been my stop loss down here. So I would have been stopped down. Compared to, let's say, this one right here. Does this look like displacement?
Did better, yeah.
Now this is a little bit more reliable. And you can see how price immediately retraced into it and started shooting right up.
Into that FEG, yep.
So when it comes to shifts, I recommend, or I encourage actually, always wait for the displacement to give you the sign that it is ready.
So a shift with a displacement. Yep. That's going to be obviously a lot more probable and give you a little bit more strength in that direction.
Yeah, especially because there's scenarios where an inducement can happen. Now, an inducement is similar to a stop rate. The difference is that it happens in a PD array. So, what does an inducement look like? Let's draw it right here first. An inducement looks like, let's say price did this, then did this, and shot up, and there was a fair value gap right here. So this low gets stop rated within a PD array and immediately shoots right up. That's an inducement. It's a form of manipulation where price, again, with the purpose of stopping you out, takes you out before the real move. Now, variations of this can exist, but specifically the one that catches people off guard a lot and makes them go like, oh, why didn't this 2022 model work, is because they confuse the shift for, they confuse the, when a shift, it looks like a shift is going to happen, instead what it really is an inducement. So
It's
in this
inducement
case,
instead, yep.
we didn't have that. Price did not wick out this low. It closed with displacement and broke the FPG, so there was no inducements there, making it a higher confluence reaction. Now on the retracement, we in this case we did have an inducement, and this is how it looks like. So as price retraced to the fair value gap, it took out this previous high with wicks, right? No displacement, no nothing, just wicks. This was to wipe out anyone that had entered short and had to stop at break even here, and immediately do the real move lower. So this is how it kind of looks like. This is what we call a nice inducement right there. And that's the 2022.
So in that area there, one thing, sorry, not to get confused with like an inverse fair value gap. An inverse fair value gap is obviously if it closes above that value gap there. So obviously it wicked above, but then closed inside of it. That's still classed as a normal fair value gap.
Yeah.
If that makes sense.
If this was to be an inverse, we would need to see the following thing. We would need to see candle body closes above the fair value gap, and then a slight retracement, and that's it.
Sure, makes sense. Yeah. So that's still classed as a normal fair value gap because body didn't close above.
Correct. Now.
Makes sense. Yep. Okay.
Sell side was the target here, and you can see they got purged. And after it
targets,
got purged, market started to reverse
Turned around.
after. That's why you don't want to be greedy with how you hold trades either. When
Of
you
course. So I guess even setting your target at the right point as well, without getting too greedy, and you miss the end of the trade.
When you
you've
see
lost
a
your
model,
target.
when you see a setup, your target will always be sell side liquidity or buy side liquidity, depending on which side. And you always want to try and measure. If this is a 1 minute model, you're targeting 1 minute liquidity. If this is a
okay, so stick to that time frame liquidity.
Yeah, ideally you want your targets to be confluential with the time frame. In my case, it's a little bit more advanced, but I'll just let you know now. But it is more advanced right now. I'd say you don't need to focus on that. But if you use a higher time frame, and you're measuring the expansion of a higher time frame, you can use the 1 minute for the model, just for the entry, and then you hold till the high time frame target is hit. But
that makes sense, and that's something I was looking at. Obviously, looking at say the model to play out on the 5 minute or the 15 for a stronger confluence, but then nail the entry on the 1 minute for I guess a tighter entry and a better stop.
That's what I do. That's what a lot of other people do, because that's exactly how you want to do it. But let's say you only have a 1 minute model, and that's the only confluence you have. Then you want to have 1 minute targets, because this could happen right in front of you. Then it hits the 1 minute target, does not hit the 5 minute, but it hits the 1 minute and then reverses on you.
And then it bounces off. Yep.
But in a simplified look, this is essentially the 2022 entry model. Raid, market structure shift, then quick retracement into a PD array. The PD array usually is a fair value gap. There could be variations. It could be an order block, a breaker, a inverse, a VPR, any sort of PD array, but ideally it's the retracement to that PD array for continuation towards the draw.
How important would you say equal highs or equal lows are before, like obviously coming up to a 2022 model? Would you say that you're really waiting to see that? I mean, if you don't see equal highs or lows, would you still take that trade? Is it not an A grade anymore if you don't see those levels?
That's a good question. I would say it depends a bit on the context of how it was formed.
Okay.
If, let's say, as we did the stop rate, we made equal highs, I wouldn't think of it too much because this equal highs could just be the manipulation to then go to in the
Mm-hmm.
future. But
Yep.
let's say we're making this and we have this firm PD array right here, and we have this high time frame equal highs right above that has not pursued yet, I would be a
Mm-hmm.
lot more skeptical because it's definitely the chance that this
Yep.
is just a whole little consolidation manipulation to then send
Before
it
it
to the
comes back
final.
up to that level.
So
Yep. Makes sense.
it definitely depends on the context of how it appears and what's making it appears. Was it made
Yep. Okay.
during news? If it's made during news and it's like a data high or a data low, it's like, okay, this could definitely seem like more of a drama than if it just randomly happened during like 1 minute price action.
Gotcha.
Now,
That makes sense. Yep.
I'd say this is kind of like the easiest model to kind of focus on, to use as your
Mm-hmm.
confluence for entries. The hard part now comes is just identifying the draw of liquidity. The draw of
Yep.
liquidity is essentially where the high time frame candles want to pursue. Now, my recommendation is you use the 4 hour, the daily, and the 1 hour to measure your draw. I don't really use the weekly, but if you want to try using that as well, you may. And our daily objective practically is to guess, well, not guess, but try and measure what the probability is that the 4 hour candle is going to expand towards buy side or sell side. So the way that I do it, I practically start my day. So I open the 4 hour chart. Well, in this case, kind of like a no-brainer that we just keep pushing up. But you
Yeah.
open
Big
the
time.
you open the 4 hour chart, and you try and gauge based on the price action what it's doing. Now, an important
Mm-hmm.
thing to keep in mind is time is fractal. So all of the little TA and everything that goes on, practically, it's the same sort of movement in every time frame. You can treat the
Yep.
4 hour as if it was a 1 minute time frame, and that's how you kind of want to you kind of identify the draws. So if I was to
Mm.
treat this 4 hour time frame as if it was the 1 minute time frame, first thing I notice, assuming that we haven't done the pump, right, is okay, we took out this sell side liquidity.
Mm.
Right after we took out that sell side liquidity, I see that we tried to make a pump up here. We did kind of make a shift. It was a wick, so it's a little bit less trustworthy, but it came right back down into the fair value gap here and respected it. Okay, then it tried shooting all the way up here and rejected it. Then
Yep.
it came once back more down here, made a 4 hour inducement, and now it's attempting to go for this 4 hour buy side liquidity right here. So let's say you start the day around Tuesday and you have that price action right here. For now, ignoring the fact that we pumped, of course, from the data, I
Yep.
would assume that the draw, since it made an inducement, retraced and hit this 4 hour order block, the draw would be buy side, at least this one right here. I don't know if it's going to hit this one up here. I have no idea
Mm.
of that. But from the structure at hand, I can assume that it's going to try and hit this one right here at least. So seeing that, you can try and gauge that, okay, the 4 hour looks bullish. Now let me look in the 1 hour. Is there any structure in the 1 hour right here that tell me that it's going to go higher? We pushed up, we fell to go higher, we respected this bearish fair value gap, we pushed a little bit lower. Nothing, necessarily.
Mm.
So you can be more patient and be like, okay, well, I don't see anything in the 1 hour, I guess I'm just going to wait. But you have the hint, price wants to go higher.
Yep.
With that hint,
So that inducement obviously helped you give that push up.
yeah, it's essentially giving you hints of what the probability is that it's going to do. For now, the hint is that it's going to go higher, but you don't have much data from that. And that's where you use the middle time frames. The middle time frames, I use them specifically, the 50-minute and the 5-minute, to kind of determine if there is a high time frame model or if there's any structure that's giving me bullish sentimentality. So since we're assuming that we're in the second of, we can see based on the 15-minute time frame, not really much. It's just kind of like a little grind down. 5-minute time frame was a grind down until this point where we start pivoting back upward. So I don't think honestly there would have been any entry model. But
Yeah, unfortunately, it was a nice push, but yeah, nothing there.
yeah, there would have been no entry model based on the 5 or 15 minute. But you can see that okay, it ended up making the shift right here in the 5 minute. It
Hmm.
ended up making the stop rate right here. And if you had a bullish draw of liquidity and you saw this, you're like, okay, wait a minute, I could potentially have an entry because my bias is bullish. I see that we're doing all of that structure in the 5 minute and 15 minute. In this case, the 15 minute is giving us a bullish fair value gap. So you might, and that's what I mean by time is fractal. In the 5 minute, in that very spot, it might not seem like we have anything that you could use as a PD array, but if you go to the 15 minute, there was a fair value gap right there.
Yep, there it is. Yeah.
So there's confluences. There's things that saying this can
Mm.
go higher. You don't have any confirmations though, so then you hop into the 1 minute. Does the 1 minute show us anything that tells us to go long? Yes, it does. So between all of that mess,
Hmm.
what we had right here was a 1 minute shift with displacement.
Yep.
What we had right here was a rate. And
Yeah,
what
there
we
it
had
is.
right
Yep.
here was a retracement to the 1 minute fair value gap.
There you
That's our
go.
2022 model.
Mm.
Now, between all of the mess, right, we had the hint that the 4-hour wanted to go higher, so that was our draw. The 5 minute and 50 minute structure told us the price was inclined to push up, although there wasn't necessarily anything like for a confirmation of entry. But when we went to
Mm.
the 1 minute, there's the model that you're familiar with, the 2022 model. In this
Yep.
case, it does have bearish confluences as well, right? We have this bearish fair value gap right here that could definitely send price lower. So you're kind of
Hmm.
fighting these two PD arrays. What makes the
Mm.
difference? Why did this work and why did the other one fail? It's completely based on the draw. If, let's
Yep.
say, the 50 minute or the 5 minute showed more bearish structure than bullish structure, I would not take this 1 minute model because that's telling me that it's more inclined to go lower than it's inclined to go higher. And this is a game of probabilities as well. You
Of
want to
course.
find more things that justify your trade is going to be more successful than this potential outcome because this is in confluence. In this case, we had several things in confluence that gave me a sentiment of higher probability that this would work over this CB. So, if you like it, you make your risk parameters. What would be your risk parameters for every 2022 model? Hard stop will always have to be the very high or the very low. In this
Do you
case,
take it to that tick on the low, or do you go 1 or 2 points lower? I mean,
I do
how
it
active
to the
do you
very
go
wick.
to the week? Yep.
Now, there's a difference between soft stop and hard stop. For me, hard stops are the
Of
ones
course.
that it hits. No point in me bothering to try going back in because that means the model failed. And if the model failed,
We're looking
I
for
was
something
simply
else now.
wrong,
Yep.
right? That
Hmm.
was another thing with when I used to trade levels. When I was wrong, I didn't know if I was really wrong because levels bounce and whatever. But with
Of
this,
course.
you know you're if when you know you're absolutely wrong, there's no point in going back in because it's not gonna work.
There's no second try. That's all right. Models failed. Yep.
Mm-hmm. But there are two forms of doing it. There's the hard stop where you essentially you must have the stop loss at that point because if it takes it,
Hmm.
it's probable that I was wrong. It did end up respecting the SIBI. Oh, there's the inversion. Now it's gonna start going for sell side.
Mm.
Simple as that. Then there's the one.
Do you find with the? Oh, sorry. Go on.
Then there's the ones where you base your stop out of candle closes or how it reacts to certain PD arrays. Sometimes Nasdaq is going to have quite a large swing range. In this case,
Mm.
this swing range is of 16 points. But sometimes it can be 30, 40, maybe even 50 swing point range. And
Mm.
then it comes like, can I really comfortably lose? Let's imagine this is 11 now, the risk here. But let's imagine it's 30. Can I comfortably really lose 30 points in this setup?
Mm.
No, then you have a different choice. Either one, you size in lower so that this feels like an 11-point stop instead of a 30-point stop,
Hmm.
or you base your risk out of how candles react to certain points. So, for example, if I want to play really, really passively or really carefully, if price closes below this fair value gap, and shows disrespect, just close the trade. If you put
Hmm.
your entry right at the 50% of that fair value gap, then technically you're only losing 2 points.
You lose 2 points, nothing. Yeah.
Or you could do the same thing, but on the second PDRA. If price closes below this one, well, then there's likelihood it's gonna straight up come for the low. So I can, instead of
Yeah.
taking those extra 4 points of loss, I can cut it for 6 points of loss. So instead of 11,
Yeah.
I lose 6.
So that's
There's
where your risk management really comes into play, and depending on how aggressive you want to play it, how safe you want to play, you've got a few points of contact there.
Yeah, absolutely. A little tip is
Interesting.
ideally after 3 PDRAs are disrespected, your stop loss is likely to get hit. So in
It's
this case,
next. Yeah, that makes sense.
We have 2 PDRAs here, and kind of like a little. I won't even consider it an order block, but we have 2 PDRAs. Let's imagine we have 3 fair value gaps here, right? Let's just imagine.
Yep.
If
Hmm.
these 3 fair value gaps get disrespected, I would close the position because it's very likely it's
More than likely,
it's.
it's coming for that low regardless. Yep, that makes sense.
And there's a lot more advanced PDRAs that you'll learn in the future, but
Hmm.
ideally, if all of those confluence for any sort of setup or trade that you're about to take, if all 3 are disrespected, it is likely that you are wrong. Because ideally, if you're really, really right, it will respect the first PDRA and run. If price action is a
Should.
little
Yeah.
bit, it's not necessarily sluggish, but it's like,
Mm.
you know, combative,
Consolidating through. Yeah.
it won't hit more than one PDRA and then go. But if it's
Then
really
bounce off.
manipulative, it can be a prick and actually take out the low and then shoot up. Things like that.
That makes sense. Yep.
But
Okay.
those are the 2 ways that you kind of want to manage in this model. I tend to rely more on hard stops and candle closes specifically because there are a lot of times that, let's say, price does this and then shoots up. So I like to wait a little bit for the candle to close below what would be my
I
hard
have seen
stop.
I have seen you do that, which makes sense. Yep. So you see whether it closes with a big wick or if it's closing with the body close, and then define what you do from there.
Yeah, JD does the exact same thing because there's a lot of times that Nasdaq likes to manipulate. But if you want to be really
And that
disciplined,
was my question before, that in an instance like this where you've got your low with your 3 weeks down below there, do you see with the 2022 model that it does come down maybe and just tap it at the wick and then bounce straight off? Or if it breaks through, I guess it's all dependent whether it breaks through completely or whether it does come back to make an equal low and then shoot back off again.
so in this case, it made 3 equal lows. If I was seeing this and I saw, oh wow, we made 3 equal lows down here, I wouldn't really care about it
Hmm.
because it's the 1 minute. So for me, it
Yeah,
wouldn't be like too crucial,
it's not
especially if
strong
it's
enough. Yep.
fresh.
Mm.
If it was, let's say, a 5 minute, 3 equal lows, and we were right here and we were in a bearish period, I'd be like a little bit more on the
A
fence.
bit more skeptical on it. Yeah, makes sense.
But that's exactly how you want to manage the risk when it comes to these things, and it's very important that
I
you're
like that.
disciplined
That's
with it
neat.
as well. You know, you want to keep in
Yeah.
mind that to pave your path to success to it, it's more risk management. Because there's a lot of
Yeah, big
strategies.
time.
There's a ton of different
Mm.
concepts in the trading world. And although, you know, I shed on patterns and I shed on indicators, that's why I don't really have anything in my charts like
Hmm.
that. They work for a lot of people. Why do they work for a lot of people? Because they have good risk management. Risk
Yeah.
management is going to be the key thing here. Knowing what sizing to have for your accounts and knowing how much to overexpose yourself to certain things. You might think,
Mm.
oh wow, I can't really risk 30 points, but if I'm right, do I really want to make, let's say, 50 points with small sizing? That kind
Mm.
of thinking messes you up. Like it
Yeah,
leads to you
big time.
failing.
Yeah, 100%.
Ideally, you want to make it so that whatever you're risking, you're going to double it or triple it.
Yeah.
But you don't want to make it so
I've
that
always been
whatever
working
you
off a
expose
one,
yourself
one
to,
to two or 1 to 3 at least, sort of as a minimum, and then work upwards from there.
yeah,
But obviously not getting greedy too, and setting targets at the right point, making sure the market's not going to reverse you at a 2 or 3 R, and then you're back to score one. You've lost a good trade.
mm-hmm. So you're a risk to reward man since you've came from practically forex as well and CFDs.
Hmm.
That's ideally how you want to try and do. You want to have a good proper risk to reward, a good sizing, but most
Yeah,
importantly, this is going to come with time as you do this
of course.
repetitive. You want to build.
This is really neat. This risk management setup, like as you just showed, that I wasn't aware that three Peter rays that would fail. That would mean, obviously close there, where I was sort of strict on the sense that if I set a stop, I made it known to make sure that I'd never move my stop, whether it's either less or more, just to keep it there. But that makes sense. To cut a loser quicker, you'd rather just be out of the trade, without losing sort of another additional 6-7 points there. You could get away with it a bit quicker and just be out with a smaller loss. I do really like that. That's neat.
Yeah, and another recommendation, you know, if you identify trends, easy to tell trends, 5 minute, 15 minute, don't try and fade them in using 1 minute entry models.
Yeah, yeah.
That's a key thing. That was one of the longest things that took me to learn for myself. 1 minute entry models against the trend is very risky, in my opinion. They can work, but you're
Yeah.
practically trying to catch the top using a small time frame that doesn't determine draws, really.
Yeah.
So since you're kind of like a beginner, my recommendation is whenever there's a trend, you wait for a 5 minute shift or a 15 minute shift before trying to fade it. Because when that happens in the 5 or 15 minute, then you could potentially see an actual trend change. Don't
Yeah.
don't try doing a 1 minute 2022 model against the trend. You're gonna have a bad
Against the trend. Yeah, big time.
All right.
In terms of looking for a trend, like long, high-term time frames, I mean, are you basing it sort of off the, like you said, the daily 4 hour M1, and then like at that, say for example with NQ, obviously it's just been an uptrend galore lately, but I mean, is that how you're sort of finding your bias to say I'm only going to be taking longs today, or do you look at it in a different way?
In all-time high territory, it is a bit tricky. I don't really
Mm,
like long in premiums, but sometimes it's like, what can you do, right? Price just wants to go higher
of course,
non-stop.
we've got no other areas to look at. Yep.
So it is tricky. Ideally, you want to wait for price to come into a discount to go higher.
Hmm.
In high time frame, price doesn't seem to go to a discount most often. In this case, it did here, but then we started just
Yep.
rallying and rallying, and we never came back to
Just
discounts in
running
high
up.
time frame.
Yeah, no retracement.
In this case, you could try using 1 minute discounts on premiums. So, for example, right here, right, this was the 10 a.m. window from Friday. How familiar are you with the Fibonacci's?
With Fibonacci, I haven't used a whole lot,
Okay,
but for some retracements, we did use it, but the settings are all mixed up on someone else's that I was learning from. So
so here's the settings for the premium to discount fib. Just gonna copy them.
yep, I'll have to copy those later. Yep.
Just take a picture of it if you want. I'll
Yep,
guide
I
you.
think I will.
All right.
Done.
So, how does this work? This kind of gives you the estimate if you are chasing a trade. It helps identify if you're chasing a trade, and it also helps identify if you're not in the trade, where you could potentially catch a move in it. You
Hmm.
want to measure them. Yeah, don't worry, guys. This is recorded. You guys will be able to view this. So, ideally, you want to measure this at every swing, distributive swing. And that goes to say, what's a distributive swing? It's just these moves, right?
Yep.
Up, down, up, down. You want to measure from those points. In this case, since we're
Hmm.
using the 1 minute time frame, we measure from the very bottom, the very swing low, to the very swing high. This is
Yep.
our premium to discount range. Now, ideally, you want to do this in high time frame as well, but in this context, we're in all-time highs. Price just keeps pumping up, so we can't really use it in high time frame. So we're using it in the small time frame, which isn't necessarily bad, but
Mm.
it's to your question, right? If we're so high up and we know that price wants to keep going higher, how do we catch longs without buying at the very top? We can
Of
use the
course.
fib on the 1 minute swings. In this case, from here to here, we have these areas, the 0.5, 6.2, 7, 7.9. What does this mean? This is all OTE, also known as optimal trade entry.
Yep.
Essentially, the algorithm, when it does the retracements, is likely to hit these areas before expanding back to the opposite direction. In this
Hmm.
case, we see price came back all the way to 0.5.
Yep.
0.5 is referred to as equilibrium. It is the 50% that cuts through premium, discount. So anything above 0.5 is premium. That means
Mm-hmm.
similar to the RSI that you're so familiar with. It's overbought.
Yep.
You don't really want to go
Mm-hmm.
long when price is at premium. You want to go
We're
long
still
when
in a
it's at
premium.
discount,
Yep.
when it's cheap. Below
Mm-hmm.
0.5, it's at discount. So how do you use
Yep.
that when you want to try going long? Well, when you see price touch equilibrium or touch any sort of these OTEs, you could technically do your entry. I don't, because I like to see it respect certain things first, but you could.
Mm.
In this case, if we were to measure it like this, here's our stop rate, here's our shift, came all the way to a premium, came all the way to a discount. Remember I said that I could hit any sort of PD rate? In this case,
Yep.
it hit this 1 minute order block, and that was enough to send it right back up.
That's your entry, and that's clean off the 0.705 there too. Really clean.
Yeah, it helped us a little confluential thing. So how does this help us? Well, just like we did that shift right there, we had a bullish fair value gap right here, and we had a bullish fair value gap right here.
Mm-hmm.
This bullish fair value gap, although if price is to be really, really bullish, yes, it's going to respect and continue going higher. But keeping in mind, we're at a premium. Do I really feel comfortable risking longs here? If yes, well, of course, you take your trade. But if not, well, let's see if it comes back at a discount. What's here nearby discount? This one right here. But is this at discount, or is this still in premium? It's still in premium.
Still premium.
Okay, I'll wait a bit more. Let's see something in discount. We have the order block. And coincidentally, this would be the third PD array. So if this one got invalidated, you can pretty much think that, okay, the low is next.
Yep.
For me, how would I risk manage this trade? Well, if I know that this is a third PD array, I don't really have to have my hard stop here. I can just wait to see what happens here. Just risk whatever this little bit is.
Nice and tight.
But, and of course, I wouldn't recommend having a hard, like the actual stop loss there. I'd see like, okay, let's see if it closes below it or if it doesn't close.
See what happens.
Yeah, it's a good way.
Makes sense.
Make that little quick move there.
Wick through and then continue back up.
But that's
I like that. That's clean. Another set of three PD arrays there. That's neat. It looks good. So I guess with the 2022, it's obviously the main things we look at are obviously the market structure shift, the liquidity sweep, but then other things like the fib. It's just extra confluences that you can use to just get you to that A grade setup that you know that it's going to give you a higher chance of winning that trade.
Yeah, 100%. There's always like little niche things that you can add to it. There's different also variations of the 2022. We'll go some things that will go into the future because since you are kind of a beginner with this, it's not necessary.
Yeah, it's still a lot to take in from the beginning. One thing I can say too, like from trading the RSI divergences that I have been looking at, I've kept them up on the chart while watching your streams too, and I find that there is a lot of the times where we do get a similar entry on that divergence. That from my divergence that I've seen, it's given me an entry to retake along, and then either from where you're at, where we're looking to long again from whether it was a 2022 model or something else differently, but it has been quite similar. So I thought even to put that in conjunction with the 22 model, to keep that in play, to just use it as another sort of another confluence to say, yeah, we're either taking off from here, we're looking for a reversal back up, we've come through a retracement. Would you recommend to keep that on board or try and just stick to just these sort of parameters? Does that make sense? What?
I would say,
like, I don't want to overcomplicate it and say, using all these different indicators and go crazy with it, but just that I have seen it has played quite similarly.
I would say there's a lot of ways that you can make profitable strategies. I know traders that use EMA still while using ICT concepts because it helps their models, it helps their confluences. I know people that do use MACD, stochastic, things like that. If you feel like the RSI helps your confluencing and helps you determine certain things, then you should keep using it. If you feel it hinders you more than it does give you good ideas, then I think you should stop. The whole point is that, after this, you're going to go on your own, you're going to play around with it, you're going to see how many times it works for you. You're not going to obviously jump out of this, because this is like, I'd recommend this is something you want to keep grinding and practicing to the point that you build that confidence. But if you start to notice that, RSI isn't really helping me, push it away. Or if you notice that, RSI is helping me a lot, then you keep it firm and you keep doing the same thing you've been doing, but with this as a confluence. For example,
makes sense.
Before digital time theory, which is also something a bit more, I recommend you watch JD's videos on it. But before doing that, I didn't use any indicators in my charts because I didn't have any use to it. But when I started
Yep.
using his root candle indicators, I started noticing that, this is complementary to my current form of training. I'm going to keep
Hmm.
using it.
There you go. Yep. So I
Mm-hmm.
guess you've really got to make sure it is complementary to what you're already looking at. Otherwise, if it's confusing you more or sort of taking you away from those entries that, oh, now I've looked at this and it's taken me off my clean model and the model played
Yeah,
out and
that's
you're
the
going,
thing
shit.
too. You don't want to overcomplicate yourself. You want to keep things simple.
Mm,
Things that you could
big time.
practically, like I said, I'm practically explaining to you the whole entire 2022 mentorship in an hour without you having to spend your
Yeah, big
life
time.
watching that series.
100%. Yeah.
Yeah, there are things that are overcomplicated and things that are really simple to teach, but
Mm,
it's definitely that you want to avoid the little noise. You want to focus on what's right in front of you, and you don't want to overthink too much either, because too much information can actually do more harm than good.
100%. I think that was the beginning of my trading career, that just looking at so many different things at once and four charts up at once, looking at all these different time frames, waiting for this and that. And then it scares you out of trades. And then you end up, you miss your entry or you take it too late. There's so many other factors that can happen. So
Yeah,
100% makes sense
100%.
what you're
Like,
saying.
if I were to say, I'd spend like 4 or 5 years of my trading career just going through all of the noise until I figured out what was really good. Because it's all
What you
about,
need and what you don't.
yeah, it's all about identifying what you need and what you don't need, and what is actually
Yeah, big
worth
time.
spending time on.
No, beautiful. Cleared up a lot today. Tyrant, really appreciate that. Heat with the just seeing it clearly on the chart too. So obviously now it's just time to back test and try and see it live and go from there.
Right, man. Here's a recommendation though, because I know that you're really close to payout and it's your very first.
Hmm. Yep.
Let's say, because there's gonna be weeks that are you new to the server?
I've been here probably 3 months, I'd say 3 or 4 months at this point.
Oh, then you've seen me get my ass kicked. You're fine. But
Yeah, yeah, no, we see, yeah, 100%. I've seen a bit of
there's
everything
weeks
at this point.
there's weeks where price action can be rough or things can be really like
Of
bad.
course.
And you being close to payout, your very first, it might become a heavy emotional burden that let's say $50 away, and then you're back to being
Yeah,
down 400 away.
100%. Yeah.
It can be a very heavy emotional toll. So my thing is, I recommend turn off your brain and just keep doing what you've been doing. And even if there are
Yep.
losses, do not change your sizing. Keep the sizing constant. Keep the risk
Hmm.
constant, and you'll see that you will achieve the payout, even if it takes a couple of extra days. Because what happens a
Yep.
lot is that people get so close, then take that one little loss that sets them
There's
back,
so much pressure on it. Yeah.
and then they go haywire trying to make it back, and they blow the account.
And you lose the account, then you're back at square one, 100%.
Yeah.
It can
So
happen so quickly, it can happen so easily. So no, you're right. I think the best thing, like you said, just keep doing things exactly the same and just keep going through with it.
yeah. Now with this model, I encourage that you kind of practice it. You back test in your own time as well. Try and
Hmm.
see how many times it works for you. If it does, this is what I love about ICT. If the model doesn't work for you, it's because you're missing
Mm.
something. And if you're missing something,
Yeah.
you can try
Okay.
and discover what it is by yourself. And if you can't figure it out, then you can just come back to me and talk to me about it,
Killed
and
it.
I'll let you know.
Yep. Of course.
Now, I would say
No, done.
this is a good chunk of information for like your very
Heaps.
beginner stage.
Yeah. 100%. Heaps to take in for sure. 100%.
Once you get a good grasp of this to the point that you can teach it to someone else, everything I've kind of told you here and everything in the recording, pretty much, I
Hmm.
would say you can schedule another one-on-one to then talk about more advanced things, because there's a lot
Beautiful.
of different
That's a good way
things.
to think about it. Yeah.
Yeah, there's a lot of different things that comes to this. So
Hmm.
I'd say when you feel ready to do another one-on-one is when you can teach it to someone else. If you feel like you can confidently teach what I
Yep.
taught you here to someone else,
That's neat.
then
Yep.
schedule another one.
Come back again. I like that. Sounds good.
All right, my man.
Sweet. All right. Thanks, heaps for that today. Really appreciate that. Like I said, it was massive help, and that's it. Fingers crossed. Let's get to a payout, eh? Let's do
Yes,
it.
sir. You got this, brother.
No, that's it. Thanks, man. Appreciate it.